This LOS is compare a company's cost of equity, its accounting return on equity, and investors' required rates of return. Equity, securities, and company value. So now we're going to look at the accounting return on equity. So return on equity is the primary measure that equity investors use to determine whether the management of a company is effectively and efficiently using the capital they have provided to generate profits. It measures the total amount of net income available to common shareholders generated by the total equity capital invested in the company. It is computed as net income available to ordinary shareholders, i.e. after preferred dividends have been deducted, divided by the average total book value of equity. So here we have the formula for return on equity, and that shouldn't be new. We've studied accounting, hopefully, in the previous LOS. So again, net income, that is from the income statement, and average book value of equity is from the balance sheet. So remember, from our ratio section, when we have a ratio where one item is from the income statement, which is for a period of time, and one item is for the balance sheet, which is as at a certain date, we're going to use the average book value of the equity. And how do we do that? We use at the beginning of the year plus the end of the year, and then we divide by 2 to get the average book value. And again, that net income, that's the net income available to common shareholders. So it's net income, you got to take off the preferred dividends, okay? Just a quick reminder, but I think you've probably familiar with that. Now there's something in the text here with this section which doesn't come up in the accounting section, and you really have to have your radar on for this one. It says that sometimes you can use the formula net income for the period T using the book value of equity T minus 1, which is at the beginning of the year, okay? And the text says that both equations are okay as long as you're consistent. So again, recalling from the financial analysis techniques, we've spent a lot of time on the ROE because we demonstrate the application of the DuPont analysis of return on equity and calculate and interpret effects of changes in its components. So we recall that ROE can be broken down through the DuPont formula, net income over sales times sales over assets times assets over equity. So again, this section here on the ROE, nothing should be too new to us. Okay, just want to do a quick screenshot from the ebook, and you can see this section, accounting rate of return on equity. So I just wanted to show you that yes, net income over book value of equity is here, which is the book value at the beginning of the period plus the book value at the ending divided by 2. And here was, this, as I said, this was a fairly important concept, and I just wanted to highlight that equation number 3 is showing that it's the net income divided by the book value at the beginning of the period, and I highlighted there in blue, both formulas are appropriate to use as long as they are applied consistently. For example, using the beginning of the year book value is appropriate when book values are relatively stable over time, or when computing ROE for a company annually over a period of time. Average book value is more appropriate if the company experiences more volatile year-end book values, or if the industry convention is to use average book values in calculating ROE. So these are the small points that are sometimes buried within the text that it's important to pick up on, because you may not have seen the convention of using the book value of the equity at the beginning of the year, but there it is in the section here on equities. So we'll do a practice question here. Calculate the 2009 return on equity of a stable company using the following data. Total sales, £2.5 million. Net income, £2 million. Beginning of the year total assets, £50 million. Beginning of the year total liabilities, £35 million. Number of shares outstanding at the end of 2009, 1 million. And the price per share at the end of 2009, £20. Is the ROE A, 10%, B, 13.3%, or C, 16.7%? You can see why I spent some time on that calculation for ROE, where it's calculated as net income divided by the book value of the equity at the beginning of the year, because this question said it's the ROE of a stable company. So companies' ROEs can be calculated as net income divided by the book value at the beginning of the year. So for 2009, Book value at the beginning of the year is easy. It's just the total assets minus the total liabilities, which is the 50 million minus the 35 million pounds. That gives us 15 million pounds. Therefore, the ROE is the 2 million pounds in net income divided by 15 million pounds, and that is equal to B, 13.3%. Okay? Equity securities and company value. So now we're moving on to the cost of equity and investors' required rates of return. The cost of debt is relatively easy to estimate because it reflects the periodic interest or coupon rate that the company is contractually obligated to pay its bondholders, its lenders. When a company raises capital by issuing equity, the cost it incurs is called the cost of equity. Unlike debt, however, the company is not contractually obligated to make any payments to its shareholders for the use of their funds. So I put here in bold, this is really important to understand, that as a result, the cost of equity is more difficult to estimate, okay? So two models are used to estimate a company's cost of equity or investors' minimum required rate of return, and it's the dividend discount model and the capital asset pricing model. So again, we've seen lots about the capital asset pricing model throughout the CFA curriculum in many different LOSs. These models are discussed in detail in other curriculum readings, as I've said. So that should not be, we're not going to go into big detail here about the dividend discount model or the CAPM. But needless to say that the investors' required rates of return, the cost of equity, the two methods that we use to compute it is the dividend discount model and the CAPM. Okay, this question is really easy because we've just seen the slide, and also I like to always sometimes include not only the most difficult questions, but sometimes the easier ones, because throughout your practice and on the exam, you face a wide range of questions from easy to medium to difficult, okay? Now, I would consider this one to be very easy, and you can see this is clearly not a 90-second question, so if you know this one, you're confident on it, that's a slam dunk, move on. You can spend some more time perhaps where there's these longer calculation questions, okay? So which of the following measures is the most difficult to estimate? A, the cost of debt, B, the cost of equity, or C, investors' required rate of return on debt? Okay, this question should be fairly easy. B is correct. The cost of equity is not easily determined. It is dependent on investors' required rate of return on equity, which reflects the different risk levels of investors and their expectations about the company's future cash flows. So again, I just copied and pasted from the previous slide. You saw that the cost of debt is relatively easy to estimate because it reflects the periodic interest or coupon rate that the company is contractually obligated to pay its bondholders. When a company raises capital by issuing equity, the cost it incurs is called the cost of equity. Unlike debt, however, the company is not contractually obligated to make any payments to its shareholders for the use of funds. As a result, the cost of equity is more difficult to estimate. And one last practice question for this LOS. A company's cost of equity is often used as a proxy for investors' A, average required rate of return, B, minimum required rate of return, or C, maximum required rate of return. Again, this question should be fairly easy because it's been included in other sections throughout the CFA with regards to the cost of equity and using CAPM. B is correct. Companies try to raise funds at the lowest possible cost. Therefore, the cost of equity is used as a proxy for the minimum required rate of return. And that's the last slide for this LOS. Thank you.